Good day, my name is CPA Gaudens. Today we are continuing with accounting for national income on the methods of calculating national income. We have three common methods of calculating national income. The first one is output method or value added method, or sometimes it may be referred to as value added method. Under this method, we calculate national income by adding up the value of all final goods and services produced in an economy during a year. To avoid the double counting, we only count the value added at each stage of production. So under this method, we have the formula there, which is GDP, which is equal to summation of value of output minus value of intermediate consumption. Here we have the example as follows. Assume if a farmer sells the maize to a miller for 200 and the miller sells a maize to a wholesaler for 400 and the retailer sells to a consumer for 500. So there the intermediate value is 0 to a farmer, 200 to a miller, 350 to a wholesaler, and also and 400 to a retailer. So the value added to each agent here, a farmer added 200, a miller added 150, a wholesaler added 50, a retailer added 100. So when you add up these ones, you'll get the gross domestic product. So we are done with value added by subtracting the intermediate consumption in order to avoid the double counting problem. So this 200 here is included in this 300, which will be an error. And also this 350 is included in this 400. So when you add them, you are doing double counting problem. Another method is income method. Under this approach, we measure the total national income by adding up the factors of production payments. For the component typically includes wages and salaries, which are compensation for labor, rent, income for land and property, interest, returns on capital, profit, returns to entrepreneurs. The formula there. Under this method, you should consider, put in your mind, you got something called NDPFC, which is stand for net domestic product and factor cost. It is factor cost because here we're dealing with factors of production. Factors of production. Yes. So we are taking the payment of factors of production, which are wages and salaries, which we may label it as W, rent plus interest plus profit. There we get net domestic product at factor cost. So put it in your mind. So under this method, you got that one. Note, the profit includes three components. Assume you are doing a business and you have a shareholders. Au shareholders sasa unatakiwa walipe gawio ambao walicontribute capital yao kwenye biashara yako. Ile gawio unalowapa ndio inaitwa dividend. Na pia serikali nayo itaingilia kati, itataka kitu kinaitwa kodi. So kwenye ile faida utatoa kodi ya serikali. Sasa kwenye ile faida kuna kitu utabakiwa nacho inaitwa undistributed profit. So the profit which you remain with after paying dividends, corporate taxes is undistributed profit. So when you sum up all them, you get profit. So when you are given dividend, corporate taxes, and the undistributed profit in a question, you should add them to get a profit, which is a component in the income method. Put it in your mind. Okay, we've got another third method, which is the expenditure method. This method looks at the total spendings on final goods and services by different sectors of the economy. The economy is built up by different sectors which build economy at large. So we have four main components which are consumption, which is tended as C. So household spending on goods and services. Another component is investment, which is I. Business spending on equipment and constructions. Another component is government spending, standard G. Public spending on infrastructure, salaries, and etc. Net export. Here we're talking about international trade, which are export and import. So to get net export, you take X minus M. So the value of export minus import, you get net export. The formula there. Put it on your mind. In this formula, the answer which you get is GDPMP. GDPMP, gross domestic product at the market price, which will be C plus I plus G plus X minus M, where GDP MP represent the gross domestic product at market price. Also, you should put in your mind that all answers obtained in these three methods, they should be equal. So the answer obtained in output, income, on expenditure should be equal. So if we get 200 on output, 200 you should also get in income, and also 200 on expenditure. So national income is equal to net national product at factor cost. So when you are told to find net national income, so the identity should take into mind is net national product at factor cost. In short, is NNPFC. Note, when you are required to find things like NNPFC, NDPFC, NNPMP, and etc., use the following converters. The key converters or economic adjustments: depreciation, which will be used to convert gross to or from net. NFIA, NFIA, which is for net factor income from abroad, which will be used to convert domestic to or from national. Net indirect taxes, which we will get it by taking indirect taxes minus subsidies. It will help us to convert market prices to or from factor cost. Example formulas by using those converters. So in your mind, you should know that the net indirect tax equals to indirect taxes minus subsidies. Net national product at factor cost equals to gross domestic product at market price minus depreciation plus net factor income from abroad minus net indirect taxes. Another one is net domestic product factor cost, which is equal to gross national product at market price minus depreciation minus net factor income from abroad minus net indirect taxes. Also, you should know personal income equals to national income, which is abbreviated as NNPFC, minus undistributed profit plus transfer payments. Also, you should know about the disposable income. Disposable income is equals to personal income minus personal taxes or direct taxes. Thank you for your attention, and don't forget to subscribe, share, and like, and comment also. God bless you.